This is your Wall Street wake-up call. Global stocks falling a day after the Federal Reserve's March statement. This as the dollar loses steam. I'm joined now by Craig Erlam, a senior market analyst at Oanda, based in London. So, Craig, the Fed leaving rates unchanged, also saying it's going to hike rates 2 times this year instead of 4 times, which was the forecast it had back in December. So why are stocks lower this morning?
Well, I think US futures are really just taking some of the lead from Europe, and when we're looking at the European stocks, it's not entirely clear necessarily why they're falling. We haven't seen this big news announcement, we haven't seen this big economic release that would necessarily drive them considerably lower, and we actually got off to quite a good start. I think what potentially we're seeing here is we've seen a lot of strength in the euro over the past 24 hours or so, partly driven by what we've seen, a continuation of the trend from late last week, but then this dovishness from the Federal Reserve last night just gave it that extra kick higher, and now we've seen quite a considerable rise in the euro over the past week or so, and I think now we're starting to see that negative reaction that we should expect in European exporters, just simply because a lot of the little growth that we've seen in Europe over the past year or so has been primarily driven by the weakness in the euro, and the combination of Draghi last week and Yellen this week is maybe just hitting them a little.
So when we talk about the dovishness from the Fed, this dovish dot plot, I mean, how much of that is a function of the Fed being worried about the global economy versus the U.S. economy?
I think it's just the Federal Reserve coming more into line with reality. I think when we saw the 4 rate hike expectations at the end of last year, I think everyone was a little bit amazed because many people didn't even think it was the right time for the first rate hike in December. So I think really when you're talking about a gradual process, 4 rate hikes within 1 year when other central banks are heading in the other direction was a bit of a surprise to people. So I think the fact that the Fed is just coming back in line with market expectations, I think, is a positive thing. I think when we're looking at global growth figures and things like this, I think that really does justify a very slow and very gradual path of tightening, which 4 rate hikes this year wouldn't have really adhered to.
But do you think the Fed is more worried about the global economy or the U.S. economy? I mean, of course, we just had a nice reading on inflation, the CPI up 2.3%, so that's above the Fed's target.
I think the US economy is fairly robust, but we've got to remember that this is a very globalized world, and if the global economy starts to slow, then that is inevitably going to have negative implications for the US economy as well. If other central banks are therefore stimulating their economies to try and boost growth and to try and lift inflation, that's going to have impacts on the Fed's on the US economy. It's going to have an impact on US inflation, which is going to affect the Fed's job as well. So I think there is primarily the global situation that's driving the Fed to slow the path of rate hikes rather than what's happening closer to home.
All right, and just very quickly, what's next for the markets now that we have the Fed out of the way, at least for right now?
I think it's just going to be a big focus on data and central bank communication. I think it's going to be the important thing. We've got a number of central bank events out the way this week, but we continually hear from them. And what we've seen over the past week or so is that the markets are very, very sensitive to central bank communication.
All right, Craig Erlam, a market analyst at Oanda. Craig, thanks so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.